One recent year, more than 6,700 millionaires relocated to Dubai, not as tourists, as residents. Some transferred family offices, others moved holding companies, investment assets, or regional headquarters. At almost the same time, shipping companies, including Maersk and CMA CGM, began rerouting vessels away from parts of the Red Sea after attacks on commercial shipping increased near the Bab el-Mandeb Strait. Flights crossing sections of the Middle East adjusted routes as airlines monitored regional airspace risks. Marine insurance premiums rose on some Asia-Europe trade corridors. Meanwhile, Dubai's luxury property market was still recording billions in transactions. Homes above $10 million continued selling. New towers launched across Business Bay, Palm Jumeirah, and Dubai Creek Harbor. Jebel Ali Port stayed active. Dubai International Airport remained one of the busiest international transit hubs on Earth. From the outside, almost nothing looked different. But Dubai was never built like a traditional oil city. It was built like a giant transfer point. Passengers transferring between continents, cargo moving between ports, capital moving between jurisdictions. Companies using Dubai as a regional base because things generally kept working. That distinction matters. Systems designed around uninterrupted movement can become sensitive to relatively small disruptions long before the skyline changes visually. The business Dubai was actually selling. Dubai understood relatively early that oil alone was not enough. In the 1970s, hydrocarbons helped finance expansion. But the leadership also understood something more important. Oil revenues fluctuate, while logistics networks can generate activity continuously. So the city started building infrastructure around trade. Jebel Ali Port expanded aggressively during the 1980s and eventually became the largest container port in the Middle East. AFSA, the free zone surrounding it, allowed foreign firms to operate with fewer restrictions than existed in much of the region at the time. That attracted manufacturers, logistics operators, distributors, and trading companies from dozens of countries. Then, aviation scaled the model further. Emirates Airline transformed Dubai into a long-haul transfer hub connecting Europe, Africa, and Asia through a single airport network. A passenger flying from Lagos to Bangkok or Manchester to Mumbai could pass through Dubai instead of London or Frankfurt. That created traffic. Traffic created hotels, retail, finance, real estate, and business services around it. By the early 2000s, a British consultant, a Nigerian commodities trader, an Indian shipping firm, and a Chinese electronics distributor could all operate inside the same transport and banking ecosystem. Dubai's non-oil economy now accounts for roughly 95% of GDP. Half a century ago, the city depended heavily on hydrocarbons and regional trade. Today, the economy revolves around aviation, logistics, tourism, finance, construction, and real estate. Entire districts appeared within a single generation. Dubai Marina expanded along coastline that barely existed as dense urban land decades earlier. Palm Jumeirah reshaped the shoreline so dramatically that satellite images became part of the project's marketing. The Dubai Metro opened in 2009 and rapidly became one of the busiest driverless rail systems in the world. After enough years of uninterrupted expansion, many investors stopped viewing Dubai as a volatile Gulf outpost. The consistency itself became part of the product. A city designed around arrival. Dubai depends heavily on new people continuing to enter the system. Foreign workers built much of the infrastructure. International firms filled office towers across DIFC and Sheikh Zayed Road. Developers sold large numbers of apartments before construction finished through off-plan financing. In some projects, buyers committed years before completion. Many expected prices to rise during construction. For long stretches, they did. Today, expatriates make up close to 90% of the UAE population. Very few major economies operate with demographics that internationalized. The growth cycle reinforced itself. New residents increased housing demand. Housing demand supported construction. Construction expanded lending, contracting, retail, transport, warehousing, and professional services. Then, more workers arrived to support the larger economy being built around that expansion. Dubai also benefited from timing. After Brexit, some British professionals and business owners looked for lower tax jurisdictions with strong international connectivity. After sanctions pressure increased on Russian wealth following the invasion of Ukraine, Dubai's luxury property market saw another influx of buyers. At the same time, entrepreneurs from Africa and South Asia increasingly used the city as a commercial bridge connected to global banking and shipping systems. The UAE also expanded long-term residency programs. The Golden Visa allowed investors, professionals, and business owners to secure longer residency without relying entirely on employer sponsorship. That reduced friction for people relocating assets or families. The city was offering practical advantages. Fast company registration, large international school networks, modern airports, global banking access, relatively low taxation, and business regulations that many investors viewed as easier to navigate than alternatives across the region. Competition became more aggressive. Dubai was never only competing with nearby Gulf cities. It was competing with every jurisdiction trying to attract internationally mobile companies and wealthy residents. Singapore continued expanding as a financial and shipping hub in Asia. Switzerland remained deeply embedded in private banking. London still retained major advantages in finance, arbitration, and legal infrastructure, despite Brexit. Then, Saudi Arabia accelerated its own regional headquarters strategy. In 2024, multinational firms seeking major Saudi government contracts increasingly faced pressure to establish regional headquarters inside Riyadh. That mattered because headquarters bring long-term commercial activity with them. Executives, consultants, legal firms, accountants, corporate travel, and commercial real estate demand. In some sectors, companies started reconsidering how much activity should remain concentrated in Dubai versus Saudi Arabia. The shifts were not dramatic overnight. But cities built around inflows tend to notice smaller behavioral changes early. Office expansions slow. Property purchases take longer to close. Developers delay launches. Banks tighten financing standards slightly. Recruitment pauses quietly inside firms expecting slower growth. None of that immediately changes the skyline. Cranes can remain active for years after sentiment changes underneath the market. The infrastructure beneath the lifestyle. Dubai can appear extremely permanent from above. Glass towers, artificial islands, multi-lane highways, luxury retail districts. But underneath the skyline is a heavily coordinated logistics system. The UAE imports roughly 90% of its food. Large sections of the country's water supply depend on desalination plants operating continuously along the Gulf Coast. Consumer electronics, pharmaceuticals, construction materials, machinery, and industrial equipment arrive largely through maritime trade routes connecting Asia, Europe, and the Middle East. Before sunrise each day, container traffic moves through Jebel Ali toward warehouses, hotels, hospitals, supermarkets, and construction sites across the emirate. Most residents experience only the finished version of that network. Stocked grocery shelves, air-conditioned apartments, reliable delivery apps, hotels operating 24 hours a day. The underlying machinery becomes more visible when shipping routes change. During periods of disruption in the Red Sea, some cargo vessels traveling between Asia and Europe rerouted around the Cape of Good Hope instead. That added fuel costs, labor costs, and transit time. Insurance rates increased on some maritime corridors. Shipping schedules became less predictable. The effects usually appear gradually. Imported materials become more expensive. Construction timelines stretch. Freight planning becomes harder. Retail margins tighten. Cities built around logistics rarely experience pressure all at once. More often, friction spreads slowly across interconnected systems. Why fast-growing cities react quickly? Factories are difficult to relocate. Ports take decades to build. But money moves quickly. That matters in Dubai because real estate occupies such a large role inside the broader economy. Foreign nationals account for a major share of property demand, especially in luxury developments and investment-focused housing. When international demand accelerates, construction expands rapidly. When demand cools, the adjustment usually starts underneath the visible surface. Developers postpone projects. Banks become more selective about financing. Contractors reduce hiring. Retail slows in districts built around rapid population growth. The skyline itself can still look almost identical during the early stages. Tourists continue arriving. Hotels remain active. Restaurants remain crowded. But expectations inside the market begin changing. And in fast-growing property systems, current pricing is often tied heavily to assumptions about future arrivals. 30 years of consistency. One of Dubai's biggest achievements over the last 3 decades was operational reliability. Flights connected through the city continuously. Ports functioned efficiently. Business regulations remained comparatively stable. Contracts were generally enforceable. Infrastructure kept expanding. That consistency helped transform Dubai from a regional trading port into a global commercial hub, integrated into international finance and logistics. Very few cities have scaled that quickly while remaining functional at the same time. Within a single generation, Dubai developed into one of the world's largest aviation and tourism centers, while continuing to expand ports, highways, free zones, and residential districts simultaneously. But systems built around global connectivity also become more exposed to disruptions affecting trade routes, capital flows, migration patterns, and transportation networks. Not because the model suddenly stops functioning, because the margin for friction becomes smaller. The environment around the model changed. Dubai is still one of the most connected cities in the world. Its airport continues handling enormous international passenger traffic. Investment is still entering the market. Major developments are still under construction. But the global environment surrounding the model looks less straightforward than it did during the peak globalization years of the 2000s. Borrowing costs increased sharply after years of cheap money. Governments became more competitive about attracting wealthy residents and multinational firms. Trade corridors faced more geopolitical pressure. Shipping routes became less predictable in several regions. At the same time, Dubai still depends heavily on systems remaining open and efficient. Air traffic, imported labor, shipping corridors, international finance, continuous business formation, and population inflows. That does not mean the model stops working. Jebel Ali still processes millions of containers every year. Aircraft still land at Dubai International around the clock. New towers are still rising across the skyline. But the city now operates in a world where logistics networks, capital movement, and geopolitical relationships are becoming harder to treat as permanently stable. And for a place built around movement, those changes tend to appear in scheduling systems, freight costs, financing decisions, and relocation behavior, long before they appear in the skyline itself.